Welcome to the Nellai Money School. Whatever be your age, gender, education or experience, understanding money and your personal finance is very important. Contrary to popular perception, getting such an understanding is very easy and I am here to help you. The subject of this episode is interest. Interest in the context of money. What interest is, how it is normally stated, and how it is computed whenever you take a loan or make an investment. So this understanding will help you do that with proper knowledge. I will also talk about percentage as a concept and related stuff which get used a lot in the context of money. Please stay on till the end of the episode to understand these things and the subject matter of the next episode, and interestingly a new money quiz which you can participate in. The simplest way of understanding interest is to look at that as a rental for using someone else's money. Let's say you are using someone else's car. So you may be paying $100 per day or 3,000 rupees a day. Or let's say you are using someone else's house through Airbnb. You may be paying $100 per day in a suburb of Boston or 6,000 rupees per day in a suburb of New Delhi. So what you notice is that there are two parameters. The amount you pay and the period for which you get to use that stuff of someone else. Now let's look at the same in the context of money. Suppose if I borrow $100 from you, I pay $5 for every year of use. So parameters are 5 and 1 year. Money being a standardized measure of value, it makes sense to standardize these two parameters as well. How are they standardized? Fairly simple. So you talk about, in this case, $5 per $100 per year. So that is a transaction. So per 100 is standardized to per cent. Cent means 100. Per 100 is same as percent. And per year is also known as per annum. Annum being a year. So $5 per $100 per year could easily be abbreviated to 5% per annum in the context of a dollar transaction. So it's written as 5% PA per annum. So it's a very, very simplified, standardized concept which will always be used in the concept of interest in the context of money. So this 5% per annum, or whatever figure we agree, is known as the rate of interest, or ROI, rate of interest. What are the factors which influence the rate of interest? It's a very vast subject and beyond the scope of this episode. For day-to-day use, there are a few factors which influence the rate of interest which you need to understand. Number one is the credit rating of the borrower. The borrower is a person who gets the money and the lender is the person who gives the money. So the credit rating of the borrower is a very, very important factor which influences the rate of interest. Credit rating simply means the likelihood of the borrower paying back the interest on time as well as paying back the principal on the due date. It depends on, let's say if I am the borrower, my wealth, the income I generate, more importantly, the cash flow I generate, and my past record or behavior of paying back similar loans taken from you or somebody else. So the credit rating of the borrower. The second factor is the fact whether the loan taken is secured or not. So what is being secured? If I take a loan from you and give my car or my wife's jewelry or my house as a security against that loan, so you have a hold over some of my assets, that means the loan is secured. So the loan is secured, I am likely to get a lower rate of interest than if it is not secured. The third one is the currency or the denomination of the loan. So stronger currencies normally operate on lower rates of interest, and weaker currencies operate on higher rates of interest. We will not get into the subject of what makes a currency strong or weak at this point in time. Suffice to say that if a student takes a loan in US dollars for his education, he pays a lower rate of interest than a student who takes a loan in Indian rupees for his education, because the US dollar is relatively a stronger currency compared to the Indian rupee. Let's talk about some more practical aspects of interest rate. Though interest rate is always mentioned as percent per annum, it doesn't mean that all transactions are on 100 units of money for a period of 1 year. You basically end up using that percent per annum proportionately to the amount of money involved, to the period actually involved. So let's say, for example, a loan of 50,000 rupees is taken at a rate of interest of 10%. So the loan is not 100 rupees, is 50,000 rupees. So what you do is 50,000 multiplied by 10%, which is 10 divided by 100, 10 for 100, for every 100. So when you multiply 50,000 by 10 divided by 100, you get the result of 5,000 rupees. So the interest on 50,000 rupees as a loan for 1 year is 5,000 rupees. So you proportionately increase or decrease depending on the amount being higher than 100 or lower than 100. Similarly, it is not necessary the period is always 1 year. So in this case, 10% per annum has come to 5,000 rupees. So if it is for 6 months only, it is half a year. So 5,000 multiplied by half, which is 2,500. So percent per annum is proportionately increased or decreased depending on the amount being different from 100 and the period being different from a year. Now let's come to banking. When you put your money in a savings bank or a fixed deposit, please remember, the bank is borrowing money from you. And the bank aggregates all such sums of money collected from various people like you, individuals like you. They pull the money together and they lend that money to people who want to borrow larger sums of money. So it's business. In India, on savings bank, you get probably about 3.5% per annum. On fixed deposits could be 6, 7, 8 or 9% per annum depending on the period for which you give the deposit to the bank. Savings bank is lower because you don't tell the bank to what period of time you are giving the money to them. No, tomorrow you may deposit today and tomorrow you may go and withdraw. So that's the reason why they can't really decide how long they can use your money. While in the case of fixed deposit, they get a definitive view as to how long they can use the money. That's the reason why fixed deposits carry a higher rate of interest than savings bank. Again, these rates vary depending on the countries and the currencies. So places like US or Singapore, both savings bank as well as fixed deposit rates are going to be much lower because the currencies are stronger. And in other countries where the currencies are weaker, the rates of interest are likely to be much higher. Now let's look at the other side. When you are going to borrow from a bank or someone else, if your credit rating is good, you should get a lower interest rate. Similarly, if you are taking a home loan where the new house you're buying is being given as security, you should get a lower interest rate. So everything is negotiable. So don't go by what the bank puts up in its brochure. You can negotiate depending on your individual credit rating. Also remember, when credit card companies they let you pay the balance later, is a loan, is indirectly a loan, and they charge exorbitant rates of interest. Be careful when you decide to defer your payment to the credit card company. Now let's talk a bit more about some hidden aspects when it comes to loan. Sometimes the loan giver, the lender, charges a processing fee apart from the rate of interest. Let's say I'm taking a loan of 1,000 rupees from a bank at a rate of interest of 10% per annum. But the bank also tells me, please upfront give a processing fee of 2%. So effectively this is what is happening. The bank is giving me 1,000 rupees as a loan, but is taking back 20 rupees, that's 2% of 1,000 rupees as processing fee. See, in effect, the loan I get in my hand is only 980 rupees. But the interest of 10% on 1,000 rupees is 100 rupees. And the 100 rupees is the interest I pay every year for a loan which effectively is 980 rupees. So if we divide 100 by 980 and convert that as a percentage, it becomes 10.2041%. See, effectively I am paying a higher interest than the interest which the brochure talks about. You should be very, very careful about this. Second is sometimes various retail stores and manufacturers, and even at times real estate companies, they tell you defer your payment without any interest cost. But there's nothing called zero interest cost. So what you need to understand under these circumstances is the difference between the total you pay later and what you pay in one lump sum in one go immediately, that is the interest you effectively end up paying. So deferred payment at zero interest is a myth. Don't fall for that. As we come to the end of the episode, let me summarize. So whether it is taking a loan or making an investment, please fully understand the rate of interest applicable, including the hidden cost like processing fee, etc. Feel free to ask the person, ask your source as to what the effective rate of interest is. Compare multiple sources and take a decision as to which way you want to go. Having done all these things, you may still want to know what is a good benchmark or a reference rate for interest rates. So that will come in the coming episodes. We'll talk more about related aspects of interest in the coming episodes. Now to the money quiz. Please take a look at this group of singers. Identify them. They have sung one of the most popular songs on money. Please give your correct answers in the comment section. In the coming episode, I will list the names of all the winners who give the correct answers. It's bye for now. Thank you for watching.